Good evening. This is the Eye of the Storm podcast for the S&P 500 for Sunday, June 12th, 2022. Extremely interesting Friday, extremely interesting gap down to start our Globex session and into next week. I have made some changes to the labeling and to reflect more exactly with what I believe is going on in the market. And so let me just do a little bit of explaining here before we dive into what actually took place on Friday, what happened to that triangle pattern, what that inflation number really did tell us, and where we are in conjunction with the entire scenario. I am doing a podcast which may produce a little bit longer update. And for those that would have an interest, I also did a podcast for the NASDAQ, but within that NASDAQ, I go into much more detail, studying and looking at the economy, looking at trading, looking at trades and things of that nature, and not necessarily and how that, and it is how it relates to the NASDAQ itself, but those same concepts, that same discussion is applicable here in the S&P. So if an interest lies, you might want to go in and check out the NASDAQ update as well as the S&P. So this one I may try to keep it a little bit shorter. Okay, what I've done is I've gone back to, on an intermediate degree, which is the yellow, to that we've completed intermediate wave A and intermediate wave B. Prior to Friday, so for example, I was continuing to label this as intermediate wave 1, intermediate wave 2, which would put us in an intermediate third wave. Now, that's still minor wave 1, but what it really suggested is that the intermediate third wave, or the minor third wave, the minor third wave, is going to be bringing us down at least to below 3,400, if not down to maybe 3,300 even, or a little bit lower, before the minor third wave is complete, and then setting up a minor 4, and then we still had a minor 5th to complete the intermediate third wave. So we're looking at levels that I would be associating with where I'm expecting that primary A wave to be put in and complete. So I went back out and I looked at it. It's like, well, if we're still in that minor third and we're counting this as minor 1, then these are going to have to come in as A and a B versus a 1 and 2, simply because of the size and the time that's going to take for all of this to unfold. Now, having said that, C waves can be devastating. C waves can be destructive. C waves can wipe out price points in a single bound. And that pretty much is what I think we're dropping into. So let's take a look at what took place. So here we are, Friday morning, 5:30 Pacific, 8:30 Eastern. Out comes that CPI number, showing that inflation again is higher. And now we're back at that highest rate in the last 40 years. So the market nosedived right off that number, and then just continued to nosedive after the US session started, and pretty much carried the downside all the way through, at least on the daily chart, right through the close. Now, what happened to that triangle? Well, as I had left off on Thursday, I had given that if the possibility, like, okay, we're at, we closed around 4,017, 18, and we had dropped below the lower boundary of the triangle pattern, and still had to leave open the possibility that, well, we could jam higher, because remember, still waiting for the CPI number. There was a lot of talk, a lot of pundits, a lot of media saying, well, that might be relaxed. We got the Fed doing this, we got blah, 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 talking up a buy-side scenario. Now, whether I want to consider that to be misleading, bad press, et cetera, makes no difference. The fact is that it could have. So as to present it in the way that they did, produced a lot of bullishness leading up to the number in the way things traded, et cetera, et cetera. And then on top of it, we did have just a weekly expiration with this major expiration coming in on next Friday, the 17th. And by the way, that is still going to happen. Maybe a big change, but that is still going to happen. Now, what did actually happen produced what I had discussed, the failure, and if the market continued to decline, it would leave us with a minor wave 2 completion point at 42.05. Now, mind you, I have rolled out to the September contract for analysis purposes. So this was the 42.02 level basis the June contract, which will continue to trade next week. But I'm telling you, I think it would be a very dangerous thing because what's left needs to be rolled. And so we can get really spiky moves in that March contract, which will not be reflected back out in the June necessarily. So I've moved out to June to just make it smoother trading and to be more reflective exactly what's going on in the market. So the couple of the adjustments is that here we had 38.07, I believe 38.08 is now 38.10.50. And then we have 42.05.25 on that top side. That completed minor wave 2. But if you remember, I continued to roll with the fact like, it's very strange because we only have 3 up. So all along I was like, well, it needs to get up above that 42.02, which was the June high. That needs to finish what I thought could be a 5-wave structure to complete a wave and then drop. Now, what did happen, of course, is that it didn't, and it started to come down. So basically, what is that? Well, as it stands, the S&P continues to have the stronger candidate for a triangle pattern, but it failed miserably, so we can't consider that. So basically, it's nasty, it's ugly, but it turns into a wave 1. So if this is the completion point for minor wave 2, we have minute wave 1, because we're in that minor third, consists of 5 waves of minute degree, and then a bunch of fluff and a bunch of nonsense and a bunch of up and flipping all over the place. And wave 2 ends in a failure, C wave failure. This ends up being 5 waves up, ends in a failure at 41.67, again, basis of September contract. It failed to take out that high, and it failed to take out or even equal. Or it failed to take out this high, I should say. Could have equaled that, but it couldn't take it out. So that would be where the failure occurred. So wave 2 ends in a failure, kicking off that third wave, which again subdivides. So I believe that what we're likely doing is, again, the minute third breaking down several times, 1, 2, 1, 2, and then we get a 3 and a 4, and then we get a 5 of something, a 4 and a 5 of something else. So I think that we could be in either a sub-minute or the minute. I think it's going to be the sub-minute wave 5, which is again starting off with a gap, in the start of our Globex session. So I am continuing to look for stronger downside. We now have seen 1, 2, and this being the third point of recognition where market players, market investors, market traders, everyone starts to realize, oh no, inflation's real. We are going to go down. Interest rates are going to go up more than we thought, that the situation is getting more serious, et cetera, et cetera. And we haven't even begun to add in any of the other factors that are weighing on inflation, particularly in some of the commodities, and supply and demand, and the supply chain, lots of disruptions courtesy of the Russian war against the Ukraine, plus all the political fallout, plus. So getting back to the market, what does it look like from here? Well, not only did I change that, but I also put up the Fibonacci extensions for minor wave 3. And the relationship is minor wave 3 is related to minor wave 1 in terms of on a Fibonacci basis. So what do we have? Well, what we have is some pretty serious downside laying right in front of us. And so what can I say? Well, I can talk about where our support levels are going to come in. Fibonacci support, we've already broken back below 38.90, I'm going to call it. That was support. We tend to kind of want to bounce back up to that, but now we're sinking a little bit further, almost 30 points below it. So that pretty much has been broken. So next up is going to be, we have that low at 38.10. That should provide some support. Again, nothing to shake a stick at, nothing that really is going to say, no, it's got to hold there, it's got to hold there. That may be the feeling of the market, but I just don't think it's going to hold because we're in that minor third wave and it would be expected to drop below. In fact, it has to. It can't be a third wave and not drop below that market, that level. So 38.10 is going to be broken. And I think that it likely may happen overnight or certainly during our regular session tomorrow. Then below that, we have 37.92, 36.95, 36.23, 35.56, and then we start to gap. And we can go, and this is the daily chart. I'm back into July, I've got no price points. This is a major point that I need to point out. We rallied so strongly post-COVID, that COVID low, that we don't have any real price points. Yes, we got these. We're sliding through them. We have them, and some of them are lining up. I mean, we have some at 37.20, some more, 36.56. But you see, we've got fib support also in the same areas. So here we are breaking 35.56. Should that occur, then we have a black hole. Where do I need to go? Well, I'm going back to November of 2020. November of 2020. So when we start the conversation way back when, and I was like, well, I really think our first stop on this multi-year corrective phase is going to be like 2,200. And everybody thought, oh my God, are you kidding me? That's like, no, how could we go there? That's incredible. It's like, okay. We're now at a level where where's support? Where can we find support? You want stronger support? 32.25, 32.45, 36.56. We got black holes everywhere. And now they're coming home to roost. Rally without any consequence? Sure, great, we all made money. Now we're going to go down. You won't find the price support. You can look for it. We may stop, but we're not going to break through. We will break through. And so we're going to be really finding the stronger support here. Now, some support, again, unlike the NASDAQ, the S&P has not broken the 200 moving average, the weekly 200. So that's at 37.33. I would suspect that that's going to provide some stronger support. Unless we're really flying down in a crash-like scenario or just an additional news or something, then it'll break right through it. Now remember, this is a weekly. If it breaks through it, the trigger is going to be, if it continues to break down, it will draw in a lot more selling. It's a major break. It's beginning to show us on a weekly chart strong weakness in the market. Then we start to produce these types of moves. The recognition points where things just drop, things just fall. Well, we're there. Now, whether it comes through, we're there. And I do think we're going to get back into trend. Don't forget, this was just a response to 7 down weeks. This rally was in response to 7 weeks of a down market. So, again, not exactly evil. I was thinking maybe we might get 4 weeks, possibly even stretch it out to 5. We didn't. It failed. And now we're heading back lower. So again, our support levels, 37.92, first of all, 38.10, 37.92, 37.33, which is the 200, 36.95, 36.23, 35.65. Then we break to 33.79. Let's call it 33.80. Now that level is where this minor third wave would be equal in length to the first wave. Yeah, it could stop there, but let's just review one of the rules. Third waves, Elliott's observation, third waves are most often the longest and the strongest out of a 5-wave sequence, and that would be waves 1, 3, and 5. Those are the impulse waves. Now, here's the rule. Wave 3 is most often the longest and the strongest of 1, 3, and 5. It does not necessarily need to be the longest, but what it cannot be is the shortest wave out of waves 1, 3, and 5. So if it were to come down here and equal wave 1, it's not going to be the shortest. That puts a lot of pressure on wave 5 to either come in below or to really sink the market. But I would anticipate and hope that even if we come in 100, just a little bit more, and that leaves wave A as the shortest wave between 1, 3, and 5 if 5 decides to truly extend. Again, I don't want to speculate on that right now because we have no idea. But I normally don't feel that a third wave, particularly in its form that it's in now, with wave 1 being 7 down weeks, wave 3 should be 10. It should be 2 months worth of down market, et cetera, et cetera. So 100% is at 33.80. Then we get into that black hole. We do have some price support around 32.25, 32.50, and then 3,200. Fibonacci support picks up again at 13,185, 3,064, 2870, 2800, I'm going to call it. And now we're still dropping into that black hole. So where can minor 3 complete? Could get as low as that, but I'm kind of looking for somewhere in here. And we do find some support and we do complete it down here. That's just minor 3. Then we get a minor 4 and a minor 5. And that C wave, the overall C wave and the minor 5 should be bringing us back closer to here. Now that is where I believe we will be putting in the primary wave A. Remember, largest up there, we're in a super cycle wave 4 correction. What's going to be in that? 3 waves of cycle degree. What's going to be in the first in there? 3 waves of primary degree. What's going to be inside of that? 3 waves of intermediate degree. Well, here we're working on those 3 waves of intermediate degree. I've shifted back to an ABC. So a C wave, again, can be strong, can be destructive, can take and just absolutely run with the direction. So right now, trend is down. It could run with that trend. It takes whatever it's got and it's going to run to the goal line. Right now, first goal line is at 33.80. Then we have others down below. So for tomorrow, let's come all the way back down to that hourly chart. We're going to have bounces, but you can already see they're totally insignificant. This was primarily because it was an expiration. We had an expiration Friday. We're going to be working towards a gigantic quarterly expiration. We've already gotten some news from Zero Hedge that was basically telling us that this one, if we thought that the March monthly expiration was huge at $3.2 trillion, this is suspected or is being thought of as coming in at $3.6 trillion. That's a lot of money. And that number could grow because now we're breaking down. So if they were thinking they were going to push the market up to get out of positions based on the 3.6 trillion, I don't think that's going to happen. I don't think that's going to happen. I think that we continue to go down, and that may just change that number a whole lot. So again, pressure on top of pressure on top of pressure. So we could have a fairly strong down week. Again, what I'm calling for now is, again, stronger downside, but we will bounce. Now, let's not forget that with the increase in volatility, how I equate that volatility over to our futures market is that it just shows me what or how quickly the velocity or the speed that the market will move. So I'm anticipating that the market is going to slide faster, but that's not only by itself. That volatility will also follow. If we get a bounce, it's going to move faster. And then we're going to get a quick bounce. It may be the best bounce to catch a scalp, a long scalp, or you're just going to be looking for the next selling opportunity. So that's kind of how I look at all of that. And so what I use are hourly. I'd be using the moving averages. If you're trading up an hourly chart, you can move down to the 30-minute chart. You still have your moving averages, the 4, the 8. If it comes up and breaks that 4 and gets going, you're looking for it to come up to the 8. Breaks that 8, looking for it to come up, first of all, to that support and resistance, and you're looking for the 20. I tend to, when we're in trend, I tend to use the moving averages as my resistance areas. We're trending down, that is. So here we have same deal. You got them and they come in. You can go all the way down to your 5-minute chart and you still have your moving averages. Right? Right now, we can't even get back above the 8. We didn't get above the 8, and now the 8's starting to flatten out because we're going to sit here until we get the next continent markets coming on. So again, I'm looking for additional downside. I want to also include that the trading things are really more important, but I would highly recommend going over and listening to the NASDAQ update, if nothing more than just for the trading info that I'm passing along on how we can trade these. That this is not a time to be banking on one side or the other coming through to save a position. It is not a time to be working or holding on to long positions that are not hedged. If you're just holding on to a long position, it's a recipe for disaster and you're likely going to blow out your account. It's just too dangerous. And why sit there and stew and worry and be anxiety filled about how your P&L is just going down and down and down and down and down, when you could be out of that position and going along with the market. It is much, much easier to take a $200, $300, $400, $500 loss and make that money back instead of letting it turn into a $2,000, $3,000, $4,000, or $5,000 loss, or worse, $10,000, $12,000, $15,000, $20,000 loss. These markets are going to move fast. They're going to really kick butt if you're not careful. So there are many ways to trade. If you have questions, please drop me the question into the comment section. I will respond. There are a lot of different ways to trade to make money going in both directions, particularly the downside. You can use options. There's a lot of different things. And these are also in the component stocks as well. All right, I am going to finish it up there. Again, reference the NASDAQ update for a lot of the additional discussion on what's going on and how inflation is continuing. Our next update will be on Monday, June the 13th.